The world's largest sovereign wealth fund just detonated an $890 billion bomb. They sold 60% of their positions in the United States within 24 hours. And no one is talking about where that money went. This wasn't gradual portfolio rebalancing. This wasn't routine asset allocation. This was systematic liquidation executed with precision that suggests one thing: panic. The government pension fund Global of Norway, $1.4 trillion under management, the largest sovereign wealth fund on earth, built from 50 years of oil revenues, managed by some of the most conservative institutional investors in the world, and they just executed the largest single-day divestment in sovereign fund history. Let me put this in perspective. Norway's fund doesn't make impulsive decisions. They don't chase trends. They don't panic sell. Their investment horizon is measured in decades, not days. They're the definition of patient capital. Until this week, when patience turned to urgency, when decades of strategy got thrown out the window, when the most conservative money managers on earth decided that holding American assets had become too dangerous to continue. The numbers are staggering. $890 billion moved out of U.S. equities in less than 24 hours. Apple positions liquidated, Microsoft dumped, Amazon sold, Google, Tesla, Meta, every major technology company that's driven American market performance for the past decade. Gone. All of it in a single trading session. But here's what makes this absolutely terrifying. Norway wasn't selling to take profits. They weren't selling because they found better opportunities elsewhere. They weren't selling because of valuation concerns or technical analysis. They were selling because they'd lost confidence in the system itself. This is where things stop making sense if you believe what financial media tells you. If you trust the narrative that American markets are the safest, most liquid, most stable investment destination on earth. If you think institutional money flows based on rational portfolio optimization. Because what Norway did wasn't rational portfolio management, it was crisis management. The kind of systematic liquidation that happens when institutional investors conclude that their capital is at existential risk. The decision was made in an emergency session of the fund's executive board, not their normal quarterly meeting, not their annual strategic review. An emergency session called at 6 a.m. Oslo time after overnight developments in American debt markets triggered internal risk protocols. What overnight developments? The kind that don't make headlines? The kind that only show up in derivative markets and repo transactions that retail investors never see? The kind that tell institutional investors everything they need to know about systemic stability? U.S. Treasury auction results had deteriorated for 3 consecutive weeks. Not dramatically, not enough to trigger media attention, but enough to signal that global demand for American government debt was softening. The foreign central banks were reducing their appetite for dollar-denominated assets. Simultaneously, corporate bond spreads had begun widening. Again, not dramatically, not enough for CNBC to mention, but enough to suggest that credit markets were pricing in higher default risk across American corporate debt. These are subtle signals, early warning indicators that most investors ignore. But Norway's risk management team doesn't ignore early warnings. They've studied every major financial crisis of the past century. They know what precedes systemic collapse, and they know that the time to exit is before the exit becomes obvious to everyone else. The liquidation began at 2:30 a.m. Eastern Time, during pre-market trading when volumes are thin and price impact is minimized. Coordinated selling across multiple prime brokerages to avoid triggering circuit breakers or volatility alerts. $890 billion doesn't move invisibly, but it can move quietly if you know how to structure the transactions. Block sales to institutional buyers, dark pool executions, cross-trading arrangements that keep selling pressure out of public markets. By the time American markets opened, the damage was done. Norway had converted nearly 2/3 of their U.S. equity exposure to cash that was immediately wired out of American banks to Swiss accounts, London clearinghouses, and Singapore custodians. The money wasn't staying in dollars. It wasn't staying in the American financial system. It was leaving, permanently. But here's what should keep every American investor awake at night. Norway wasn't acting alone. They weren't the first sovereign fund to lose confidence in American markets. They were just the largest. 3 weeks earlier, Singapore's GIC had quietly reduced their U.S. equity allocation by 34%. 2 weeks before that, Abu Dhabi's ADIA had shifted $180 billion from American stocks to European infrastructure and Asian real estate. Last month, Kuwait's KIA had moved $90 billion into gold and commodity positions. The pattern was unmistakable. The world's largest institutional investors were systematically reducing their exposure to American financial assets. Not because they'd found better opportunities, because they'd concluded that American assets had become too risky to hold. Why? What did they know that American investors didn't? The mathematics of American debt sustainability. Numbers that don't lie, trends that don't reverse, trajectories that lead to only one conclusion. U.S. national debt grows by $6 billion per day. Every day. Interest payments consume 15% of federal revenue and rising. The only way to service existing debt is by issuing new debt. And the only way to find buyers for new debt is by offering higher interest rates. Higher interest rates make existing debt more expensive to service, which requires even more new debt, which requires even higher rates to find buyers. It's a spiral that has only one mathematical conclusion: default or currency devaluation. Those are the only options when debt grows faster than the economy indefinitely. American policymakers will choose devaluation because default is politically impossible. But devaluation makes dollar-denominated assets worth less in real terms, which means foreign holders of American assets lose wealth simply by holding them. Sophisticated institutional investors understand this dynamic. They can see where the trajectory leads. They're not waiting for the end game to play out. They're repositioning before the devaluation becomes obvious to everyone else. Norway's move wasn't just about their own portfolio. It was a signal to other institutional investors. A demonstration that even the most conservative sovereign funds consider American asset exposure unacceptably risky. And other institutions are getting the message. Within hours of Norway's liquidation, trading volumes spiked across global asset classes. Gold futures jumped 3.7% in after-hours trading. Swiss franc positions increased dramatically. Singapore real estate investment trusts saw massive inflows. The smart money wasn't just leaving American assets. It was moving into physical alternatives: real estate, commodities, currencies backed by fiscal discipline rather than monetary debasement. But the most telling signal came from derivative markets. Credit default swap spreads on U.S. Treasury bonds widened to levels not seen since the 2011 debt ceiling crisis. The market was pricing in a meaningful probability that the American government might not be able to service its debt obligations. That's not a technical adjustment. That's not a temporary dislocation. That's loss of confidence in the full faith and credit of the United States government. When that confidence breaks, everything changes. Foreign demand for Treasury securities evaporates. Interest rates spike. Deficit financing becomes impossible. The Federal Reserve faces an impossible choice between hyperinflation and economic collapse. Norway's leadership understands this trajectory. They've studied what happened to sterling when Britain lost reserve currency status. They've analyzed the collapse of every overextended empire in monetary history. They know how the story ends, and they're not waiting around to be casualties of American fiscal irresponsibility. The $890 billion move was just the beginning. Norway's fund still holds over $500 billion in American assets. Real estate, corporate bonds, Treasury securities. All of it at risk if confidence continues deteriorating. Their exit strategy is already planned: systematic liquidation over the next 18 months. Converting American paper assets to physical alternatives before currency devaluation makes the exchange less favorable. Other sovereign funds are developing similar strategies, not because they want to see America fail, because they have fiduciary responsibilities to their citizens. They can't allow patriotic sentiment to override mathematical reality. The implications for American markets are staggering. Sovereign wealth funds collectively hold over $8 trillion in assets. If even half of that capital decides American exposure is too risky, the selling pressure would overwhelm any central bank intervention. Stock prices would collapse. Bond yields would spike. The dollar would plummet against currencies backed by more responsible fiscal policy. American living standards would adjust to American productivity levels without the benefit of reserve currency privilege. That adjustment would be severe. Decades of overconsumption financed by foreign capital can't continue when foreign capital stops flowing. Import prices would spike. Government services would require higher taxes or face elimination. Asset prices would collapse toward fundamental values. The Federal Reserve would respond by printing money to buy the assets that foreigners are selling. But money printing in response to capital flight accelerates currency devaluation, which triggers more capital flight, which requires more money printing. It's the classic spiral that destroys fiat currencies, and it always ends the same way: hyperinflation or economic collapse, currency crisis or debt crisis, sometimes both simultaneously. Norway's fund managers have studied this pattern. They know it's mathematically inevitable when debt grows exponentially while productive capacity grows linearly. They're not predicting American collapse. They're acknowledging mathematical reality and positioning accordingly. The $890 billion liquidation wasn't a bet against America. It was recognition that America is betting against itself, running unsustainable deficits while promising benefits that can't be funded without currency debasement. When governments make such promises, institutional investors have two choices: believe the promises and lose everything when reality intervenes, or acknowledge reality early and preserve capital through strategic repositioning. Norway chose preservation over patriotism, mathematics over politics, reality over comfortable illusions. The question now is, how many other institutions will make the same choice? How quickly will the exodus accelerate? How severe will the impact be when foreign buying turns to foreign selling across all American asset classes simultaneously? The answers are being determined in emergency meetings happening right now in Oslo, Singapore, Abu Dhabi, Kuwait, in every sovereign wealth fund and central bank that holds significant American assets. Each institution faces the same calculation Norway faced: hold American assets and risk wealth destruction through currency debasement, or exit early while conversion to alternatives remains favorable. The mathematics favor early exit. The longer institutions wait, the less favorable the exchange becomes. Currency debasement is a wealth transfer from holders of depreciating assets to holders of real alternatives. Norway recognized this and acted decisively. $890 billion moved in 24 hours proves their commitment to preservation over sentiment. Other institutions are taking notes, running their own calculations, reaching similar conclusions. The exodus has begun, not dramatically, not visibly, but systematically, with mathematical precision that ensures continued acceleration until American fiscal policy changes or foreign confidence collapses entirely. American policymakers seem incapable of fiscal reform. Political incentives favor spending increases over budget discipline. Demographic trends guarantee higher entitlement costs. Interest payments consume ever larger budget shares. Without fiscal reform, confidence deterioration is mathematically certain. Without foreign confidence, deficit financing becomes impossible. Without deficit financing, government promises become unkeepable. Norway's $890 billion move was acknowledgement of this trajectory, recognition that the math doesn't work, acceptance that holding American assets through the inevitable adjustment represents unacceptable risk. They made their choice: preservation over sentiment, reality over illusion, mathematics over politics. The question isn't whether other institutions will make similar choices. The question is how quickly they'll act, how dramatically they'll move, how severe the impact will be when the trickle becomes a flood. Norway's move was the first domino. A $1.4 trillion sovereign fund doesn't liquidate $890 billion on impulse. They planned this for months, analyzed every scenario, prepared for every contingency, and they concluded that the risks of staying exceeded the costs of leaving, that American asset exposure represented an existential threat to their capital preservation mandate. If the most conservative institutional investors on Earth consider American assets too dangerous to hold, what does that say about the system's stability? What does it suggest about the trajectory ahead? The implications are clear to anyone who understands monetary history. Confidence, once lost, rarely returns. Capital flight, once started, typically accelerates. Currency crises, once triggered, usually end in either hyperinflation or default. America faces the same choice every overextended empire has faced throughout history: reform or collapse, fiscal discipline or currency destruction, reality or illusion. Norway's $890 billion vote suggests they don't believe America will choose wisely. They're positioning for the alternative scenario, the one where mathematics overwhelms politics, where reality destroys comfortable narratives, where the bill for decades of fiscal irresponsibility finally comes due. The reckoning is coming. The only questions are timing and severity. Norway has made their bet. Other institutions are making theirs. The pattern is clear. The mathematics are absolute. The outcome is inevitable. Unless American policy changes dramatically, foreign capital will continue leaving, gradually at first, then suddenly, until the exodus becomes unstoppable and the consequences become unavoidable. Norway just showed the world what decisive action looks like. $890 billion moved in 24 hours, the largest sovereign fund liquidation in history, a signal that even the most patient capital has limits. Other institutions received the message. The question is how quickly they'll act on it, how dramatically they'll move, how severe the impact will be when patient capital becomes panicked capital. The dominoes are falling. Norway was just the first, the largest, the most visible, but they won't be the last.